Hey everybody, Jason Rivera here from ValueInvestingJourney.com, bringing you the first case study since coming back from working. This one's on Armanino Foods company. AMNF is the ticker. I did this, I calculated the information a couple days ago and sent it to subscribers. So some of the numbers I talk about will be different than what you see on the screen from Morningstar, so bear with me on that. And if you would like to get everything that subscribers do, make sure to subscribe on the blog. Alright, here we go. This case study is going to be showing you how exactly I go through a preliminary research on a company. And then in the coming weeks, I will be showing you more and more videos on how exactly I would analyze Armanino Foods. This is going to be the ongoing case study for the next several weeks. And I'm going to show you everything that the decisions I make, or why I make the decisions I make, and why I think what I think when going through a company research. Alright, so the first thing I do, get all my tabs open up at Morningstar, Armanino Foods, of distinction, stock ticker AMNF. Alright, first thing I look at is market cap, see what size the company is, yield, see if it pays a dividend, and price to book on this page. Alright, nothing, don't need to do anything at this point. Just follow along and keep going, or just keep paying attention right now. Okay, and then I go to the key ratios page. Get off the main page, the quote page on Morningstar, and go to the key ratios page. First thing I look at here is, okay, it's not working. There we go, operating margin. First thing I look at on this page. I don't pay any attention to gross margin at this point. I just look at operating margin because I want to see what a company earns from its operations. And the trailing 12-month operating margin is 18.7%. 5-year average operating margin is 13.8%. 10-year average operating margin is 9% for Armanino Foods. So that's what I like to see. I like to see it going up over time. And this is more than doubled over the last 10 years actually, which is very good. As you can see, going back 2002 up until 2004, their operating margins were the 2% range, which is not very good. Alright, from here I go to share count. Right here. And I look to see if the company has been growing or getting rid of shares by buying back shares, or giving or distributing a lot of shares. In this case, Armanino Foods has gotten rid of, they've gone from 70 million shares in 2007 to 32 million shares in the trailing 12-month period, or a reduction of 54% in that time. That is excellent. You don't want to see, generally you don't want to see a company issuing a ton of shares unless they're growing like crazy. That's pretty much the only case, but especially in micro caps, you want to watch out for share dilution. If you see a company increasing shares, let's say if they would have gone from 70 million and issued instead of going from 70 million to 32 million like they did, what if they would have gone to 140 million? That would have been a red flag to me. That would have meant that they couldn't fund their operations with straight growth from their cash flow, operating margin, and from their businesses. That means if they have to distribute more shares and issue more shares on a consistent basis just to continue growing, that's a red flag for me, and that's something I watch out for. So this is an excellent sign that I look for, reducing the amount of shares, because that means that your shares, if you hold on to them, are worth more with less shares out there. You still have the same amount of value but less shares. Alright, next thing I look at is book value per share. You want to see this growing as well, and it has been. It's gone from 14 cents a share in 2008 to 25 cents a share in in the trailing 12-month period, or a gain of 40% in that time. That means that's likely a lot due to the share reduction since that time, but also because of the growing operating margin and growing efficiency of the company as well. So this is all you always want to see, the book value per share growing. And from here I go to ROIC. Down, you just scroll down the page, go to profitability, and it's down here. Return on invested capital percentage. Alright, for the trailing 12 month it's 42.4%, 5-year average is 32.8%, 10-year average is 19.8%. So again, the higher this number is, the better, because that means the more percentage, the higher percentage of the company, or the higher percentage of the profits are for the company. This number is more than doubled, just like operating margin, in the 10-year period from the trailing 12-month period. So that's an excellent sign as well. That shows that revenue, that they're growing efficiently as a company. But to compare this, I also look at ROE, the return on equity percentage, right here, right above return on invested capital. This is important to look at ROI in comparison to ROIC, because our ROE will show you if the ROE is higher than ROIC, that means that the company has debt. If the company's ROE is a lot higher than the ROIC, that means the company has a ton of debt, and that's a red flag for me. But this, we'll look at debt in a little bit, but ROE of 49 compared to a ROIC of 42.4, that's fine to me. That's not a red flag. That doesn't mean the company has a huge amount of debt. Again, with ROE, the higher the better, generally. But remember, ROE can be inflated by a ton of debt. So be careful when you see a number that's higher than that, than ROIC by a lot. Okay, next thing I look for is I go to cash flow tab. We were on the profitability tab. You just click on the cash flow tab. Look at the free cash flow to sales margin right here. This is an important metric because free cash flow is king. The more cash flow a company generates, the better off for shareholders, because the company can pay dividends, buy back shares like Armanino Foods has been, and not have to rely on debt to grow. If a company has I look for margins over 5%, but Armanino Foods is more than double that at almost 11% at 10.86. What does that mean? This means that out of every $1 of sales that Armanino Foods has, that almost 11% of that turns into cash. So 10.9 cents out of every dollar of sales this company generates turns into free cash. That's excellent margin. Anything over 5% is really good. The higher this number is, the better. From here, I look at the cash conversion cycle. This is another red flag thing to watch out for. Red flags. You want to see this number generally decreasing over time or staying about the same. This Armanino Foods is a bit worrisome. It's grown from 2012. It's gone up from 52 days to 67 days in the trailing 12-month period. That's not great, but it's not terrible either. Just something to keep in your mind, that you want to figure out why the company is selling its inventory slower. That's what this number shows you. It's how fast inventory is selling. If it's selling slower, which means higher days, that's generally something to look into and can be a very bad sign depending on how much inventory is built up at the company. But looking here at the inventory days inventory has lasted is actually slowed down a little bit. So it's just something to watch out for. Nothing major at this point, but when we go through that point of looking at the annual reports, in this case study, we'll want to figure out, or at least get an idea of why sales are going slower. And then from here, I calculate EV to EBIT, EV to free cash flow, and then the inverse earnings yield as well. And for Armanino Foods, I look for anything on both numbers. Anything under 8 is preferable. That's a number that I've had success with in the past, and that's a number I've seen Warren Buffett say that he has had success with in the past. So I figured why go against the master, and may as well just go with the 8 number, as it seems to be working well for both of us. But EV to EBIT of Armanino Foods is 12.4. EV to free cash flow is 21.3. So neither are great, but they're close enough with all the other excellent numbers that Armanino Foods has produced up top. The operating margin, ROIC, free cash flow to sales margin, things like that. Since those were so good, Armanino Foods is definitely worth a look, even though its EV to EBIT and EV to free cash flow are not under 8. This is because I always like to have a watch list. I always like to know companies very well. And the quicker I research companies, the more knowledge I will have on what price I would like to buy it at. So if the company, I haven't calculated intrinsic value yet, but if this company drops in value, I would be willing to buy it if the margins stay the same. So that's why I would definitely continue to do research on this company. And earnings yield, the inverse EBIT to EV earnings yield is 8.1% for Armanino Foods, and the free cash flow to EV earnings yield is 4.7%. I look for anything over about 10%. So again, not optimal in what I would necessarily be looking for, but definitely the metrics above, again, operating margin, ROIC, ROE, and free cash flow to sales are definitely good enough that if the price drops, the earnings yield will rise, and then it would be a good time to possibly buy. And you calculate EV. Okay, thank you for watching this video. Remember, if you want to get this information faster, subscribe to the blog on valueinvestingjourney.com, and make sure to leave comments below on things I can improve on, or things you'd like to see, maybe things you'd like to see explained better. Thanks for watching.